Hi everybody, Thomas Moore here. People are always trying to figure out the best ways to make money in the stock market, but the vast majority never actually do. I think that's because most investors ignore some of the easiest ways to pick up money that the rest of the market leaves behind. I call these very real dollars the low-hanging fruit of the stock market because they're within easy reach of just about anybody that's willing to pay attention to them. Growing up, my parents often took my siblings and I to work in a fruit orchard not far from our home that was owned by our church as a resource to help needy families. It gave Mom and Dad a way to teach us about service and the value of an honest day's work, all together at the same time, especially during the fall harvest season. I have 4 younger siblings, and since I'm the oldest son, Dad always had me take a bucket and a ladder to climb into the top reaches of the fruit trees. I thought that made me pretty cool, but I quickly realized that I had to work a lot harder to get just as much fruit as my baby sister and younger brothers, who got to pick fruit from the lowest branches and scan the ground for fallen fruit that was still good. I'm competitive by nature, and that means that the difference between the amount of work I had to put in for my production compared to theirs really got on my nerves. I tried to talk my dad into letting me put away the ladder and just focus on the lowest branches. He refused because, after all, how to pick fruit more efficiently wasn't the lesson that he was trying to teach me. Years later, as I began my investing career, I began to recognize that the vast majority of investors, including me, were overly focused on a single method to make money: buy a stock or an option and hope it went up in price. I started to wonder about the person on the opposite side of that transaction, the seller. Why were they selling when everybody else was buying? Had they bought earlier and so they already made their money? What were the strategies that the most successful investors, the Buffetts, the Mungers, the Vogels, and so on, that gave them such an advantage? I remembered those days spent in the fruit orchard as a youth, watching my siblings pick low-hanging fruit and fill our fruit bins far easier than me. I started to realize that the buyers were usually like me, standing on a ladder reaching for fruit in the hardest to reach places. It dawned on me there was a simpler answer. Sellers were selling because everybody else wanted to buy. Now, it's true that sometimes sellers are people who bought earlier than anybody else, but those tend to be the exception rather than the rule. The truth is that the smartest and the most successful investors in the market are sellers rather than buyers, because selling to everybody who wants to buy is the easiest and most proven way there is to make money in the stock market. They're also quick to jump on the opportunity to create passive income from their investments. I've found 3 types of low-hanging fruit in the stock market. I call them low-hanging fruit because they're available to anybody, not just the wealthy elite. But the truth is that the average investor doesn't even see them. They're too busy trying to make a lot of money in the shortest amount of time possible with investing strategies that are guaranteed to lose money more often than they make it. The first kind of low-hanging fruit in the stock market that I want to emphasize is dividends. Remember what I said about being available to anybody? All you have to do to earn a dividend is hold a dividend-paying stock. Many of the largest, most established, and successful companies in the world pay a consistent dividend to their shareholders. It's a passive income source that's credited to your account for doing nothing more than holding shares in a company. So why don't more people own dividend-paying stocks? Because they're not stocks that tend to dominate market media is one reason. Talking heads and experts on TV tend to focus on the buzziest, fastest moving stocks in the market at any given time, and the kinds of stocks that pay dividends don't often make those lists. Dividend-paying stocks tend to move a little less quickly. Another reason is because dividend-paying stocks make up the minority of the market. As of this recording, of the more than 12,000 stocks listed on U.S. exchanges, only about 3,400, or about 28%, pay a dividend of at least 0.25% per year. Another reality that scares investors away from dividend-paying stocks is the fact that stocks cycle from high to low and back again over time. Holding a stock long enough to get a dividend means that you may have to watch the stock drop below the price you bought the stock at. That sounds scary. Working with dividend-paying stocks means taking a long-term view of the stocks you buy, and that requires taking the time to analyze the company's business and decide if it's strong enough to justify that kind of risk. It's one of the reasons that fundamental and value analysis have become primary parts of my Rebel Income system, because I want to make sure that the dividend-paying stocks I work with represent good values at the prices I buy them, with a book of business that strongly suggests the stock should be higher. Dividend yields can vary from less than 1% per year to as high as 10% or more in some extreme cases. For most well-managed and growing companies, dividend yields will usually fall somewhere between 1.5% and 4% per year under typical market conditions. When you think about the long-term opportunity for appreciation a stock may have, that's the opportunity to increase in value, the dividend offers an extra incentive, a passive income source that you can add to whatever increase in price the stock may provide. The only thing you have to do is hold on to your shares. Holding on to shares of a stock gives you the ability to do more than just take in dividends and wait patiently for the stock to go up in price. Covered calls are a basic option strategy that often gets overlooked by investors. That's unfortunate because they're passing up consistent opportunities to generate extra income on a monthly and sometimes even weekly basis. A covered call means selling a call option to another investor against a stock that you own. Since you can sell a call at any point in time, covered calls are like giving yourself an extra dividend on a stock you own along with its regular dividend. Let's look at a practical example. Let's suppose you decide to purchase stock in Walt Disney Company at its current price, $90.35 as shown here. You could, of course, simply hang on to the stock and wait for it to go higher. That's not unreasonable, but it's also a decision based primarily on hope, especially since for the purpose of our example, the stock is retracing from a recent high. Let's suppose that you bought the stock because you believe it's a good bargain at the current price. Notice that the January 2024 Week 3 contracts shown here expire in 22 days. That's a little less than a month, which puts these contracts within the ideal time frame for a covered call. The $91 strike price has a current bid price of $1.81 per share. The bid price is the amount that sellers will get by initiating a sell-to-open transaction. That's a 2% return on the $90.35 price that you paid for the stock by itself that would be deposited in your account as an immediate credit. Since selling a covered call means you may be required to sell the stock to the call option buyer at the strike price you sell, you've also built a little extra gain into the trade based on the difference between the price you paid, $90.35, and the $91 strike price the contract stipulates. That's a 65-cent per share capital gain on top of the $1.81 premium you brought in, for a total gain of $2.46 per share if you are required to sell the stock at expiration. That's a 2.72% net gain for a trade that lasts just 3 weeks. Now, if 2.72% for a 22-day trade doesn't sound impressive, don't feel bad. Most investors tend to think about making money in the stock market in much larger terms, which is why a trade like this covered call gets overlooked so often. But let's put this in a realistic perspective. If you get called out of the stock, your capital is free to be used in another trade. Maybe you'll use Disney again, or maybe you'll find something else. If you can repeat this process every 3 weeks, you'll place approximately 16 trades with the same capital over the course of a year. Achieving the same 2.72% result every 3 weeks means your net return will be a little more than 43.5% for the entire year. If you want to calculate more conservatively, let's suppose you don't get called out, meaning that your net return in the trade is 2% and you keep the stock. If you can keep selling covered calls for the same 3-week period, you'll still make 32% for the entire year, to say nothing of the additional income you'll bring in from the stock's dividend distributions. Before you start to think that my example is unusual, let me tell you, it's not. The yields offered by covered calls can easily average between 1.5% to 3% per month in the majority of cases. It's one of the simplest, most conservative, and reliable uses of options in the stock market, and it's the easiest options permission to get from your broker. And yet, most traders don't think about using covered calls in their investing systems. Understanding this single concept represented a major point in my investing career more than a decade ago. Another useful application of covered calls comes when a stock drops below the price you bought it at. As long as the stock stays below the strike price that you sold, you won't be forced to sell the stock. That's an action that traders refer to as getting called out. That means that you can keep selling calls against the stock above its current price to keep generating income. The premiums you bring in can be counted against your original purchase price, which helps minimize the impact of a decline in the stock's price and makes it easier to realize a profit in the position when the stock eventually reverses direction and goes higher. The last type of low-hanging fruit comes in the form of cash-secured put selling. Most investment advisors may warn against this strategy, and it's true that it does require a higher level of trading permission from your broker than covered calls. This can be a very aggressive strategy if you don't use it correctly, but properly done, it's really not much more aggressive than buying a stock and selling covered calls. I like to think of cash-secured put selling as a gateway to taking advantage of stock dividends and covered calls, because it offers an opportunity to control the price I'm willing to pay for a stock. Let's use Walt Disney Company again as an example. Let's suppose I want to buy Disney, and I like it at its current price at $90.35. But instead of buying it at the current price, I sell a put option with the same 22-day expiration as in the covered call example we just talked about. Selling the $90 strike price means that if the stock drops below $90 before expiration, I'll have to buy it at $90. But I like that price anyway, so even if the stock is below $90 at that point, I'm willing to be patient. For that potential result, the option buyer pays me $1.63 per share per contract, which offers a 1.8% return for the 22 days that the contract covers. Remember though, it's just as likely at this point that the stock will stay above $90, in which case my put sell will expire worthless and allow me to decide whether to repeat the process again on Disney or move on to another stock. On an annualized basis, 1.81% for a 22-day trade translates to nearly 29% return per year, which is a very attractive potential return for a one-year period. That's especially true when you consider that over the past 50 years, the S&P has averaged a total return of about 11% per year. If the stock does drop below $90 and I'm required to buy the stock at $90, I have the stock's dividends acting as a passive income source, and I can consider the value of selling covered calls against the stock to pay myself some of those extra dividends and lower my net cost in the stock over time. The cash secured portion of a put selling trade lies in the reserve requirement associated with the contract. In non-retirement accounts, put selling requires either margin approved trading or the cash on hand to secure the stock. In my Disney example, securing the trade means that I would have to have $9,000 per share per contract in cash in my account or in available margin. I don't recommend margin trading since it isn't available in qualified retirement accounts like IRAs, and it presents some additional risks that I prefer just not to deal with. It's more aggressive, so in this case, I'll keep that $9,000 in cash throughout the duration of the trade. If I'm forced to buy, which is called being assigned, I have the cash immediately available to fulfill my obligation. That makes it easier for my broker to approve this kind of trade in my account, including IRAs in many cases. Have you heard the phrase, "A bird in the hand is better than two in the bush"? Now compare covered calls and put selling against the simple buy and hold mentality that most investors try to work with, or even shorter term timing methods like swing and momentum trading. These other strategies, which I think of as directional investing, without exception rely on the hope that the stock will move in the direction that you want. Covered calls and put selling, on the other hand, put immediate cash in your account that you can repeat over and over again. In my own investing career, I've experimented with just about every trading strategy available. Commodities, futures, currencies, advanced options, spreads. If you can imagine it, I've tried it. In my own experience, directional strategies have a very low probability of success, of about 25% at best. That means you'll lose more than 75% of the time. It's possible but very difficult to make money in the long run with those kinds of probability. It's the main reason that traders using these strategies are trying to double or triple their investment per trade. It's very much like watching a baseball player swing for the fences. Even the best hitters are more likely to get out than hit a home run. Taking advantage of the low-hanging fruit of the market shifts the probabilities dramatically in your favor. In the 10 years I've been managing Rebel Income, my probability of success is more than 98.5%, meaning I have approximately 98 winners for every 100 trades I place. I've also been able to average a return of 2.38% on trades that cover a little less than 3 weeks of time for those winners. That's the number one reason my conservative, high probability results are more than 35% higher than the total return of the S&P 500 for the past decade. I've built my Rebel Income investing system to take advantage of all three types of low-hanging fruit. I start with put selling, since it acts as a gateway to owning dividend-paying stocks at prices I can determine for myself and that represent good values. I'm assigned shares from those put sales about 25 to 30% of the time. Those assignments allow me to start taking advantage of additional income opportunities from dividend distributions and from selling covered calls. Picking up the low-hanging fruit of the market puts me at an advantage versus the average investor, and it's an advantage I'd like to share with you. You can click here to subscribe to this channel, where you'll get notified about stocks that I highlight to learn more about the details of my system. If you really want to see what I do and how I do it, check out my Patreon page and consider signing up for my Rebel Income Toolbox or trading alerts. You'll find the link in the description area for this video. Thanks for watching. This is Thomas. Talk to you again soon.